Most investors watch CPI, payrolls, and PMI. But on Sunday, August 16, 2026, the report that could shape European markets over the next quarter is one almost nobody reads: the European Central Bank's June 2026 Sesfod survey. It asks senior credit officers at major banks how credit terms are changing in euro-denominated securities financing and OTC derivatives markets. Think repo, securities lending, and the margin agreements behind derivative trades. The reason this matters right now is a contradiction. On August 14, 2026, Fitch Ratings said European leveraged finance markets remained resilient in the second quarter despite disruption from the Iran war. Yet the ECB had already signaled in May 2026 that securities financing markets were seeing higher demand for funding. So the headline says calm, but the funding plumbing may say otherwise. Sesfod stands for the ECB's quarterly survey of credit terms and conditions in euro-denominated securities financing and OTC derivatives markets. It does not ask about loans to households or corporate bonds. It focuses on the machinery that lets banks and funds borrow cash against securities, lend bonds, and post collateral on swaps. Credit officers report on price terms such as haircuts, spreads, and financing rates, and non-price terms such as maturity, collateral eligibility, and counterparty limits. The value of this survey is early warning. When dealers tighten haircuts on lower-rated collateral, funds must find more cash or sell assets. That can force deleveraging before any credit spread widening becomes obvious. The March 2025 edition, for example, was released by the ECB on May 2, 2025 and showed how quickly these terms become part of the policy conversation. The key recent development came before the June survey was even published. On May 21, 2026, Securities Finance Times reported that the ECB said securities financing markets had seen higher demand for funding. That is not a small detail. When demand for repo and securities lending rises, it usually means market participants need more cash against their bond holdings, often to finance leveraged positions or meet margin calls. If dealer balance sheet capacity does not grow at the same pace, credit terms tighten. The June 2026 Sesfod results therefore landed after a quarter of elevated demand. That makes the survey a test of whether banks absorbed that demand or began to push back on less liquid collateral. The Fitch note from August 14, 2026 specifically says European leveraged finance markets remained resilient in 2Q26 despite the disruption from the Iran war. But resilience in loan and high-yield markets does not mean the underlying derivatives and funding markets are untouched. War affects energy prices, inflation expectations, and central bank uncertainty. Gold and silver prices respond to geopolitical uncertainty, inflation expectations, interest rates, and treasury yields. That volatility flows directly into margin models. When prices swing, clearing houses and dealers raise initial margin on interest rate swaps, credit derivatives, and FX swaps. A pension fund or hedge fund holding euro-denominated OTC derivatives may then need more high-quality collateral, usually government bonds. That is exactly the kind of stress the Sesfod survey is designed to catch. On August 16, 2026, the practical impact is not evenly spread. Banks feel it through their prime brokerage and repo desks. Pension funds and insurance companies feel it because they lend and borrow government bonds in securities financing markets. Hedge funds feel it because they use total return swaps and interest rate derivatives that require daily margin. If the June survey shows tighter non-price terms, the first sign is usually a reduction in maximum trade tenors or lower acceptance of lower-rated corporate bonds as collateral. That pushes funds to hold more cash or sell riskier assets. Even if the Fitch assessment says leveraged finance is resilient, the cost of carrying that exposure has likely increased. That is the gap between headline credit and funding reality. Looking ahead, the evidence points to continued pressure rather than a sudden reversal. The May 2026 higher demand for funding came before any possible reduction in war-related volatility. Since Fitch published its resilience note only 2 days before today, on August 14, 2026, markets are still pricing the second quarter shock into third quarter risk management. If the Iran war continues to affect energy markets and central bank policy expectations, dealers will likely maintain stricter collateral terms. The next Sesfod survey, covering the third quarter, will be the one to watch. The question is whether resilient leveraged finance can survive a sustained period of higher funding costs. History suggests that at first, borrowers pay more. Later, if terms tighten enough, they reduce positions. That is when the stress becomes visible to everyone. British investors might assume this is a euro area story. It is not. London remains a major hub for euro-denominated derivatives clearing and securities financing, and UK pension funds and asset managers routinely use euro government bonds as collateral. When euro repo terms tighten, the effect spills into sterling markets because dealers manage collateral globally. A shortage of high-quality euro collateral can raise demand for gilts and US Treasuries as substitutes, affecting UK yields. On Sunday, August 16, 2026, with UK markets closed, this is the right time to ask whether your portfolio's funding risk is matched to its headline credit risk. The Sesfod survey gives you a window into that hidden risk. The June 2026 Sesfod results are not about whether Europe is about to have a credit crunch. They are about how markets finance their existing positions during a war shock. Fitch says European leveraged finance has so far been resilient. The ECB's earlier signal says demand for funding in securities financing markets was already rising. Put those two facts together and you get a market that is calm on the surface but increasingly constrained underneath. For viewers, the practical takeaway is simple: watch haircuts, margin requirements, and collateral eligibility, not just spreads and headlines. If those funding terms tighten, the next move in risk assets may come from the plumbing, not the news.